Saigal as well, founder at Saigal Capital, to talk about what he's making of the markets right now. Anshul, hi, morning. Good to have you on the show. Thanks for joining in. And let's start off with banks, Anshul. Seems like the FIIs are back, and obviously they pick up the private banks first.
Morning, Aisha. Pleasure to be with you. Yes, that is true. As we have seen, the largest private sector bank getting derated over the last 3, 4 years, and particularly in the last 1 year, there has been a lot of anxiety about this bank because all other banks, private sector as also PSU, have been re-rated. But this bank was seriously derated in this phase. And this has been the sort of darling of the FIIs over the years. And clearly, they were exiting out of this bank, which led to the fall in the bank. Of course, there were fundamental reasons for that, but really, one of the reasons why this bank was doing so badly was FII disinterest. Now, in the last month, it has got a bit of its mojo back. And clearly, that indicates that there is interest from FIIs into the country. And the first bank to be bought by them is really this. As also the other private sector banks, which have consolidated for the better part of the last 3, 4 years, in comparison to many of the PSU banks who've done very well. And so, in valuation terms, they become quite attractive at this time as compared to where they were 3, 4 years back. Some of these banks were trading at 4, 5 times book and now are trading at 2.5 and lower. Even the largest bank is trading at 2.3 times book, around 12, 13 times price to earnings. I don't remember the last time that happened. And clearly, the risk reward is favorable at this point because of that.
Right. But Anshul, just wanted to pick up on what happened in the broader market yesterday. While, yeah, private banks definitely held out, but there was some serious bout of profit taking, in capital goods, in some of the consumption names. And in defense names as well. Do you think now for some of these sectors within the small and mid caps, we will see a continual profit taking perhaps, or is that advisable really?
Aisha, you see, these many of these stocks have rallied multifold. In capital goods, I know of companies that I hold which are up like 5, 6 times in the last 1 odd year. Now, to say that they still have a lot of steam left and most of the upsides are ahead of us, I don't think that would be a prudent way to approach this space. Of course, in the odd case, it always makes sense to take some money off the table. While I'm of the view that the next 3, 4 years are going to be extremely strong for this space. If you speak with companies, you throw a dart, pick a company, and they'll tell you that we'll double revenues in the next 3, 4 years. That is the kind of tailwind we see in this space. But clearly, much of that upside is already priced in into these stocks. What used to trade at 10 times price to earnings now trades at 35, 40 times price to earnings. And that tells you that the upside which is ahead of us mostly is priced in into stocks. So taking some money off the table is not a bad strategy at this time. Of course, I wouldn't also recommend taking all monies off because what kind of tailwinds in growth can happen over the next 3, 4 years. Even these companies will not be able to gauge, and as a result, staying invested is also important. But it never hurts to take some money off the table. In general, I would say that rather than worry about a day, 3 months, 6 months, take a long-term view to your investors, to your viewers, that is, take a long-term view and ride this rally by and large. 3, 5 years, you can't go wrong in India.
Anshul Saigal joins us, founder with Saigal Capital. Good morning.
Morning, Nikunj. Pleasure to be with you.
What should one do now? It's just been such a great market.
Nikunj, you see, we are all very intelligent people, and we try and impose our intelligence on the markets. Sometimes we forget that the markets are supreme, and we should learn from the markets rather than putting our theories on the markets. I remember when I was a portfolio manager till last year, At the beginning of the year, you could have spoken to any fund manager, and they were saying, stay away from small caps because they're expensive. Go into large caps because that's where you'll find safety. And from then to today, small cap index itself is up 70, 80%. And some of the small caps have given 3, 5, 10 times returns. So it is a loser's proposition to be imposing your theories on the markets. Never try and gauge where the direction of the market is going to be. Focus on the fundamentals, focus on the valuations. These are things which are in your control. Buy companies which are strong in their fundamentals, buy companies which are reasonable in valuations. And if you're smart, catch a rising tide in a sector. Manish Chokhani just mentioned that this has been a rotational bull market, whereas some sectors have done well, others have not, and that just keeps rotating over time. If you are smart enough to identify that tide, then there is so much money to be made in this market henceforth as well. However, there will be, of course, segments which will not do so well. And if you're caught in those, you will start looking at others and getting envy that the others are making money, you are not. So it's an interesting market. But having been a fund manager, I can tell you that this market is highly skewed in favor of the individual investor because he can be nimble and he can also look at concentrating bets into certain segments which will make money going forward. This is the stock pickers market. A broad portfolio will probably cause you a bit of anxiety because it will probably not go anywhere. But individual pockets, individual stocks, a lot of steam left. I think that there is a lot of money on the table still.
So Anshul bhai, what we've discussed perhaps is theory. अब practical बात करते हैं. What should one do? Simple. Which are the ideas where you think big money could be made? Which are the stocks which you think one should completely avoid, whether it is because of business risk or valuation risk?
निकुंज भाई, मैं आपको ये बता सकता हूँ मैं कहाँ इन्वेस्ट हूँ और कहाँ पे मुझे अपॉर्चुनिटी दिखती है. I can tell you that rural economy is at the cusp of a turn. And while we've had a raging bull market, stocks which are leveraged to the rural economy, discretionary rural economy, those are half from their all-time highs. So that segment has been a complete laggard because the broad market has been weak. I think that space in the next 6 to 12 months will start turning, and you are getting quite favorable risk reward opportunities at this time. So that's where one will make money, in my judgment. If you're taking a 3-5 year view, I think that even in capital goods and manufacturing, there are some really lucrative opportunities which have really not done as well as the broader capital goods and manufacturing space. And that's where, again, there will be money on the table, and you can make substantial monies from here in the next, say, 2 to 3 years. I think that financials, again, the PSU banking space, they're still trading at under one time book. Even old private sector banks are trading at one time and lower book. They're trading at 5-10 times price to earnings. And if the private sector capex is to pick up, then it is this space which will be the bigger beneficiary of that trend than not. And as a result, for the growth that they will show at 5-10 times price to earnings, they're quite reasonably positioned. Even now, the private sector banks, the well-researched large private sector banks, they offer value now because they've consolidated over a period of time. Housing finance. I can tell you some housing finance companies, if we are in a real estate cycle for the next 3-5 years, some housing finance companies are trading at very attractive valuations today for the quality that they offer. They have substantial capital on their balance sheet, and that capital is unutilized at this moment, which will offer them growth going forward. And for technical reasons, they trade at valuations which are really mouth-watering. So, to my judgment, that is a space where opportunity is again available. Um, And then there is the odd sector like sugar and ethanol, and where there are certain special situations, certain plays which are even in defense, in that space, embedded in sugar and ethanol. There are, other capital goods companies which are again special situations, one-off opportunities. So opportunities galore, Nikun Bhai. You just have to dig deeper.
I guess that's the strategy, dig deeper for those opportunities and some ideas being shared.
So, go back to defense stocks here and just look at the close in some of the defense stocks or let's say shipbuilding companies from 3rd of June. I'm knocking off the 4th of June yo-yo effect. Now look at HAL from 3rd of June. It has regained everything what it lost clearly on 4th of June. Bharat Dynamics almost there. Mazgaon, it is 20% higher than 3rd June close. Kochi Shipyard, 12% higher from the close what we saw on 3rd of June. Anshul bhai, while it's logical to understand why and the underlying reason why some of the defense and some of the railway stocks are moving higher, but what would be the yardstick at which you would say, okay, the sector will grow, but the stocks are unlikely to give great returns?
I think, Nitin bhai, there are two things to this. One is, of course, the valuations. Second is uh, the the uncertainty that we find ourselves in geopolitically. So, in a sense, defense stocks. Let's keep railways aside for a minute and just talk about defense. Defense stocks are a hedge to war. And at this moment, given the how many balls are in the air regarding that aspect geopolitically, the prospects of war are not negligible. And as a result, many investors are buying into this space as a hedge towards that eventuality. Just to go back 2 years, I should tell you that I was tracking this space quite closely in 2021, and then in 2022 February we had the Ukraine-Russia war break out. You will be surprised to know that many of these stocks at that time, which were really not, which had not done well at all, HAL and Bharat Dynamics and many of the shipping stocks, they were available at 4-5 times price to earning. Those fell as the war hit another 20-25% because there was general uncertainty in the markets. And if you were a sharp investor at that time and understood the dynamic, you would have understood that if India, which buys most of its supplies from Russia, stops getting its supplies, then India is in a huge spot at that time. So a perception will get built that India will have to indigenize, and for that, the domestic defense companies will have to do well. And as that perception gets built, whether that happens in reality or it doesn't happen, only time will tell. But as perception gets built, many of these stocks will get re-rated. From there, I know that HAL is up 10 times, Bharat Dynamics 7, 8 times. Many of the shipping stocks are up between 7 and 10 times. So that geopolitical uncertainty got reflection in how these stocks got valued thereafter. I think that that uncertainty is not down. In fact, in many ways, it's only up for our country, particularly given that we have two very not antithetical sort of neighbors to the country, and as a result, this space will remain in focus. Now, whether because of valuations you want to trim some of your positions, I think that may be a prudent strategy. I may even think that some part of your portfolio, if you don't have any defense, 1-2% of your portfolio in defense is not a bad strategy. But going all out at these prices is not recommended at all. I wouldn't do that if I was not invested in defense already. So that's how I'm thinking about this space. On the one hand, valuations. On the other hand, geopolitical uncertainty. balance between both, and then take a call on how much you need to own in your portfolios.
You, Naresh, a last word before we let you go in terms of where exactly you believe you're finding comfort within the entire defensives basket?
Um, Hi, Avan. So in the defensives basket, of course, FMCG, of course, if you really want protection of capital, large FMCG is a space where you will find that. Also, as I mentioned a few minutes ago, most of these FMCG companies are indicating that their rural business is starting to turn. And that was in the last quarter. I mean, you could have listened to all the calls, and every one of them mentioned that rural incomes, rural demand has started to turn, which should be good for them. Um, in addition to this, I would say that rural discretionary, that is a space where one should definitely consider an investment because, again, their risk reward is quite favorable. Stocks have been hammered out of shape over the last 2, 3 years, and they may have bottomed out as we speak. Because if the rural economy turns, they will do well. I'd say that these are two pockets that one should consider if one wants to be invested in defensives.
So much for joining in and sharing with us your outlook, Anshul. Let's move right on. Here are the other top.
If you like this video, then like, share and subscribe to ET Now.